Hey guys, welcome back to the channel. So as some of you may know, with my personal investments, I run a pretty concentrated portfolio of around 3 businesses, and one of those businesses is Alibaba. I feel like this has been a long time coming, but you guys finally voted it in. So today I'll be going through my stock analysis for Alibaba and sharing my research on the company. And I also have a brand new spreadsheet to share with you guys at the end of the video. Now, in the spirit of not wasting your time, I'll be skipping over the usual business overview part and just getting straight into the important stuff. Just because Alibaba is one of the more popular stocks on YouTube, and I'm guessing you guys already know how the business operates. So that's the topic for today's video, and let's get into it. One of my favourite super investors to follow, which I spoke about in a recent video, is an investor by the name of Fred Liu from Hayden Capital Management. In one of his letters, Fred wrote a really interesting piece called "Not All Margins Are Created Equal," and he says that by looking deeper at a company's reported margins, it can give us a slight edge when analysing a company's true earnings power. Fred mentions 2 types of margin profiles, and the one I'll be focusing on today is the reinvestment scenario, as that's the one that's most relevant to Alibaba. In the reinvestment scenario, a business will take profits from highly profitable lines of business and invest them into newer lines of business, which has a negative impact on the company's overall margin. In this example, the company has 3 very profitable business segments, but it also has 3 new business segments that are currently unprofitable. And then on the far right, it shows the company's overall margin, which has been dragged down considerably by the new segments. And I think this is something that's really relevant to Alibaba. As you know, Alibaba has a wide range of business segments, like China Commerce, International Commerce, Local Services, Cainiao Logistics, Cloud, Digital Media, and others. And if we look at the margins for each of these segments, we can see it's pretty similar to the example before. Alibaba essentially have one highly profitable business segment in China Commerce, which generated 182 billion RMB in 2022, and then every other business segment is currently losing money. The cloud business did just become profitable, which is good to see, but this only happened in the last 12 months or so. Now, if we look at their profitability as a whole, the overall business only made around 130 billion RMB, so more than 50 billion in profits was wiped out by investing in new businesses. In margin terms, their China Commerce segment alone generated a 30% EBITDA margin, but as a whole, the overall business only generated a 15% EBITDA margin, so the new businesses are having a pretty big effect on Alibaba's overall margins. According to Fred Liu, when we're looking at the reinvestment profile, there's 3 key questions to answer about the company. 1. Will the investment projects ever be cash flow positive? 2. If so, how long will this take, and what does the margin look like at maturity? And 3. If it's unsuccessful, are management smart enough to shut it down, and what are the signs to watch out for? I feel like answering these questions for Alibaba is really difficult in the short term, especially when I'm trying to predict when each of these segments will become cash flow positive and what the exact margins will look like. So, in order to make it a little bit easier for myself, I try to look at it the way Nick Sleep would, by looking further out than everybody else and focusing on the long term or the destination for the company. And over the next 10 years or so, I think there's a pretty high probability that each of these segments will either become cash flow positive or get shut down by management if they continue to be unprofitable year after year. I know that was a long spiel, but overall I think Alibaba is very similar to Costco, where it keeps margins low on purpose, just for a different reason. Costco keeps its margins low so it can give the customers low prices, whereas Alibaba keeps their margins low because it's a business that uses the earnings from its profitable segments to spawn new businesses, or as Monish Pabrai calls them, spawners.
But the one I want to talk about today, which is part of the renaissance this year, is the spawners. And the spawners are companies that continuously spawn related and unrelated businesses. Very few companies have the DNA to be great spawners. And we'll drill down a little bit on the different kinds of spawners. And basically, these are companies that have a deep conviction of, and really it's part of the DNA, to keep adding and incubating new businesses that have the potential to be massive growth engines. They expect many of these things to fail, and they take failure in their stride. And Amazon is one of the great spawner companies that we have. Spawning also has a lot of advantages, in fact, a lot more advantages than cannibals, because cannibals have to pay tax on their earnings and then they can use the money to buy back shares. In the case of spawning, what you're doing is you're basically reducing your net income, which basically then reduces your taxes. So in effect, you're getting a interest-free loan from the government on very easy terms, payable when able. So, for example, through most of its history, Amazon has hardly reported much in earnings. Their core businesses were quite profitable, but they were taking all the cash flows and continuously investing them into new bets. 30, 40% of the money that they were investing would have gone to the government if they didn't do that. So it's a very capital efficient way to do this if you are good at spawning.
Now, the reason I started off with that section first is because Alibaba's profits being compressed has a pretty big impact on their return on capital, and it makes Alibaba look like a pretty low quality business at first glance. Because the cash flow figure is so compressed, and the capital employed figure is so inflated because of the massive reinvestment, it makes the return on capital and the return on incremental capital look minuscule. But I don't think this is a true representation of Alibaba's true earnings power. Right now, Alibaba's core business is a very high return business, and I feel that over time, as the other segments become cash flow positive, their overall return on capital will increase significantly. I also think it's sort of similar to Amazon in the late 2000s, when it was reinvesting tons of capital into adjacent businesses. And some of those businesses took a long time to show returns, like Amazon Prime, Prime Video, and AWS, which are all huge parts of the Amazon ecosystem today. With Alibaba, it could be the same story, and many of the investments they're making now may not show returns for a few years. Alright, the last segment for today is looking at my future projections and my valuation for Alibaba. And as always, I'm just some guy on the internet trying to predict the future, so please don't take my estimates as a buy or sell recommendation. Okay, so the first part of this spreadsheet is trying to project Alibaba's revenue 10 years into the future for each individual segment. So I have e-commerce, services, cloud, digital media, KaiNow, and other. Next, I took their current revenue and applied various growth rates for the first 5 years and the second 5 years. And finally, on the right, I have the compounded growth rate for the 5-year and the 10-year. Now, you can pause the video if you want to look at the individual growth rates in detail, but in total, for the overall business, I have Alibaba's revenue growing by 9.5% per year over the next 5 years and 8% over the next 10 years. And these revenue estimates will be used in the valuation model below. The second part of the spreadsheet is basically just for show, but having the information right there is pretty helpful when trying to value a business at the end. So the first half is Alibaba's return on capital employed over the last 5 years, and due to spawning new businesses, you can see Alibaba's earnings start to compress as the base capital increases, which gradually lowers the return on capital, and only time will tell whether this will reverse if the new businesses become profitable. Okay, the second half is pretty much the same as the first, except this one tracks Alibaba's free cash flow margin, and like before, you can see it start to taper off over time as Alibaba started spawning new businesses. I think it's interesting that over the last 5 years, their base capital has compounded at a higher rate than their revenue, and my prediction is over time, this will probably translate into higher revenue growth than I have in my estimates. However, I stuck with pretty conservative estimates as sort of a margin of safety built into my valuation model. Alright, let's move on to the final section, the part you've all been waiting for. This is my valuation model for Alibaba. Now, you're probably wondering why the numbers are so large, and to explain, I need to show you this little feature on the right. In Google Docs, which is what I'm using, there's this cool little feature where you can track the data for a particular company, and it automatically tracks the business day to day. So as Alibaba's market cap moves up and down, this spreadsheet will automatically adjust itself. I also have it set so that whatever ticker symbol I put in this box, that's the company it will track. So if I change the ticker to Tesla, it will start tracking Tesla's market cap. Now, I couldn't figure out a way to shorten the market cap figure that it brings up, so that's the reason I have to use these massive numbers. It's a bit annoying, but what can you do? Alright, in my valuation model, I tried to calculate what Alibaba's business will be worth in 5 years and in 10 years. And I get this by estimating their future revenue and adding a free cash flow margin to get future free cash flow. Once I have my estimates for future free cash flow, I add what I think is a fair multiple, which gives me a market cap for the business 5 years and 10 years into the future. So for Alibaba, I used the revenue estimates at the top, which was 212 billion for 2027 and 291 billion for 2032. And for the free cash flow margin, I assumed the business would gradually increase its margins as the spawners become cash flow positive or get shut down. So for 2027, I have 20%, and for 2032, I have 25%. Alright, now that I have my estimates for Alibaba's future free cash flow, to get my market cap estimates, I used a free cash flow multiple of 15, which I think is a pretty fair multiple given the quality of the business. So overall, this gives me a future market cap of 637 billion in 2027 and 1.1 trillion in 2032. And again, these are just my estimates for what I think the business will be worth in the future. I'm more than likely wrong, but if I'm right, the little table on the right shows the potential upside for the business, which compares my estimates with Alibaba's current market cap of around 200 billion. And this fluctuates as Alibaba's market cap moves up and down in price. Right now, because Alibaba's dropped significantly in price over the last year or two, the upside's increased a lot as a result. Overall, I do think it's a great business, and I plan on holding for at least 5 years to see how the thesis plays out. If you're wondering why I didn't use a traditional discounted cash flow to value Alibaba, it's mainly because I valued Alibaba using a DCF in a previous video. It is a tutorial video, but if you're interested in the end result, then just skip to the end of the valuation. I'll put a link in the description box below. So that's my analysis for Alibaba, and I hope you found it interesting. And if you enjoyed the video, please consider hitting that like button as it really helps support the channel. As always, if you have any questions, please leave a comment down below. And if you watched the video all the way to the end, thank you so much for watching. And if you want to see the best portfolio tracker out there, then stay tuned for the quick spiel at the end of the video. So that's it for this video. Thank you so much for watching, and I hope to see you guys back in the next one. Hey guys, do you track your portfolio manually in an Excel spreadsheet? If so, you can avoid so much hassle by signing up to ShareSite for free. ShareSite is the portfolio tracking tool that I use to track all my investments. And unlike most brokerages, ShareSite automatically tracks everything including capital gains, dividends, and also currency gains if you invest in foreign markets. It's also completely free to sign up to ShareSite, and you can use it for as long as you like. And if you sign up to a paid plan, then use my referral below, sharesite.com/investingiq, and you'll get 4 months for free when you sign up to an annual plan. So what are you waiting for? Go check out ShareSite.